This session is on failed breaks and failed retests. These are often called double tops, even triple tops. I prefer to call them failed breaks and failed retests. I think this actually is terminology I may have made up myself, not sure. But basically the point I make is that I think a failed retest, where the market retests a key level and falls back without taking out that key level, is a different signal from a failed break, where a market goes higher and i.e. breaks through the previous level and then reverses. This can be both highs and lows. So if we've seen a prior high, let's say FTSE saw a high at 6,000, a failed retest would be where the market goes to 59.90 and then falls back. A failed break would be where it goes to 60.10 and then falls back. So it's probably because my grounding is an Elliott wave theory, whether or not a wave 5 takes out the previous wave 3 high is a fairly important point. In fact, it is the defining point. If the wave 5 fails to take out the wave 3 high, then it may not be a wave 5 at all. I mean, if we take this example here, I've made the count 1, 2, 3, 4, 5, but the fifth wave has actually failed to make a new high. So simplistically, I would look at this as an ABC. My first count would be an ABC. Okay. Sometimes you get fifth wave failures, but these are quite rare. So you don't want to base your trading on rare events. You want to base your trading on common events. The more common your patterns that you look for are, the more likely or the more success you're likely to see. But it is important to consider the alternatives. In fact, it's not that critical. I mean, again, Elliott wave theory is one of my techniques. Price spikes is another. Failed breaks retest is another. See, the point with a failed break or failed retest is, okay, this is a failed retest. Right. Now we take that away and we extend wave 5 like that. That is a failed break. Now they're both sell signals in this case, or buy signals if it's the reverse. So it's not so important really. The Elliott pattern becomes less important. If we see a clear failed retest, failed break, then I'm less concerned with the Elliott pattern. If that failed break or retest is accompanied by a decent price spike, or even better, 2 price spikes, then again the signal is enhanced. It's all a question of balance as to how many of these techniques you wish to apply, in what way, and on what you wish to base your trading signals. I tend to trade the major indices, FTSE and the Dow, and when it comes to binary bets, there are far more bets on those 2 markets than on many others. For example, currencies, or the Nikkei, or the DAX, or the Australian indices. They're just simply a lot more bets. I mean, things like tunnels, high-lows, one-touches are not so commonly available on other markets. However, if you wish to be very specialist and you wish to specialize in a type of signal which perhaps is quite rare, perhaps you would like a perfect Elliott 5 linked to a failed break, which of course would be the fifth wave, with a decent price spike, then I would encourage you to research that sort of signal. And you would need to look at maybe a lot more markets to see enough of those signals to satisfy your trading needs. But that would be an excellent way of proceeding and researching this matter. I often say that a trader wins in direct proportion to the work he puts in. You make your own luck in this business, as in life generally. And if you're prepared to put the work in, then you will succeed. If you want it on a plate, then you won't succeed, almost certainly. It is all about hard work, I'm afraid, and it's something that traders learn fairly quickly, which is why, in fact, many traders then decide to exit the business. Again, this is an emotional decision. Many fledgling traders come to the market having been successful elsewhere, and they think, well, this will be nice and easy and fun. I'll make lots of money trading the market, and I'll enjoy myself. I'll probably be doing it from a beach somewhere. I'll look at my computer screen for 2 minutes, put on a trade, and that'll pay for my 2 weeks in Phuket or wherever it might be. But they realise that, in fact, this is not the case, that all they're doing is losing money, and that if they're going to want to make money, they're going to have to work at it. And I suppose that's one of the key lessons, really. It's certainly one of the 55 steps, which I'll be looking at fairly shortly now. Anyway, back to the failed retests. So we'll now go down to the second chart. Okay, well, the second chart is simply the extension of the first chart, where we have seen the wave 5, and we then get the reversal. So that is the failed break. So you have again got the double top, which is that one and that one, and we're seeing a big fall down. Now, I will just make one point on Elliott here, because it's all these things are interlinked. Having seen 5 waves up, we know to expect either a corrective or an impulsive decline. We can never be quite sure about this. There are often strong indications that it should be impulsive or corrective, but generally a corrective decline will hold support on wave 4, or at least certainly have an effect. And if in fact we're seeing strong impulsive action, we'd anticipate a sort of dithery thing here, and then we'd go up again. In this case, we're seeing a very strong move down. Okay, it's idealized, it's just a chart. But that's an impulsive decline, as opposed to a corrective decline. So again, we'll move on to the next chart. Okay. Well, again, we have a chart here of FTSE, and you'll see again that there are some fairly key major turning points. I mean, it's not difficult to see double tops. There's one there. I mean, these come in all shapes and sizes. It depends on the time scale you're looking at. This is an hourly chart, so there's a double top there. There's a failed retest here. But when you've seen a sort of major low like this one here, and then you've seen a decent rally like that one there, and that there is a hint of a 5-wave pattern there, you expect the market to move back to retest it. Retests are very common. Not always dramatic, but they are quite common. Now here's one which there's no particular retest, no particular spike. Although again, this is an hourly chart, maybe something clearer on a shorter term chart. In fact, also we've got a fairly, again, an impulsive decline here, but only a very weak retest. This happens sometimes. It's basically a sign of weakness. It's if the market only bounce weakly from a sharp fall, then it suggests that we're going to go further, which of course we did do. There's a failed retest here. There's a nice double top here, which is a failed break. There's a solid spike here, which is a failed break above these here. And you see the spike itself does incorporate this level here. So it's a clear failed break above that level there. And this is a 6750 level, which is key for FTSE at this time, as I talk in November 2007. I mean, here's one that doesn't work so well. That's a strong spike there, failed retest here, but it just fills out. Having said that, for a shorter-term trader, there is a move there. I mean, a shorter-term trader would probably make money out of that. A longer-term trader may not have done, because the longer-term trader is looking for bigger profits, so would tend to hold and then get stopped out probably. So let me get down again. But it's quite. There are plenty of these things. Look at any chart, and you'll see these signals coming in, if you use these signals, you'll find that you do good trades. You'll also do bad trades. I mean, one thing I should say, and this is a very important point, is that what will happen is that when you look at the chart, you'll see all the good signals will be obvious, because they'll be confirmed by the subsequent action. However, all the bad signals will disappear from view, and this is something to be very wary of when people try to sell you software or any kind of system. It is a fact of life that when you look at a chart showing any kind of analysis technique, and let's just quickly go back to that chart we're looking at here, that the good signals, which I've just shown you, are all very clear. Okay, you got very, very clear indications of the failed retest here, failed retest here, spike high here. But there's a spike low here, for example. Okay, again, short term, we got to move. But hidden among all this action, there are going to be price spikes and failed retests. I mean, there's a failed retest there, a low, which has done nothing. So if you bought there, you'd have been immediately into a loss situation. And this is a key point, really. A trader has to be on his guard. A trader is his own man or woman. You stand on your own 2 feet. You make your decisions. You take your profits. You suffer your losses. Nobody is going to be there when you may need them. I mean, you must make your decisions, and I'm here to help, obviously. But if you're in a US trade and it's 8 o'clock at night, and you've just entered a position and something's gone wrong for some reason, you haven't followed your plan, you're exposed to a bigger loss than you expected, that's down to you. And if it's as a result of listening to somebody say, if you do this, then you'll make lots of money, and it turns out that what they told you was not the whole truth, then that is your responsibility. You must take everything that anybody says about trading with a pinch of salt. You must research everything, and you must reach your own decisions and conclusions. This is why I try to explain things in great detail and set things out clearly. And this is why I'm telling you about this now, because unless you are clear on this point, unless you do research everything, you're not building on rock, you're building on sand, and you will slip below the waves. That's not a mixed metaphor. Nothing is. Anyway, thank you. That's the end of this session, and I'll be back shortly.